Hi, welcome to the Just Some Musings podcast. This week, Justin and I speak with Andrew Pennington, who is a product specialist with the Portfolio Solutions Department of Canaccord Genuity Wealth Management. Andrew started with us in 2022 and is sort of a behind-the-scenes advisor to advisors, helping client-facing advisors like Justin and me build portfolios for our clients. CG Wealth Management is an open architecture when it comes to investment selection, and Andrew's work helps us cut through literally tens of thousands of investment products, maybe more, available to us in Canada. As always, the disclosures at the end of the show apply, and specifically, we do not want to give the impression that any of the following discussion is meant to advise you on your own particular investments. Get in touch with Justin or me via the podcast page at muhs.ca/podcast if you have any questions. And enjoy the show.
All right. So we've all done some exams. And it sounds like, Andrew, you just had one this morning. Successful?
Yep. So I had to write the Wealth Management Essentials for Investment Managers Level 2 this morning, and it was successful. So I did pass, so I'm happy to have that done.
So you're in a good mood.
Yeah, I'd say so. I mean, I hate rewriting exams. When I did my CFA level 1, I actually had to write it 3 times. And then after that, I vowed to never write an exam twice again. So I passed level 2, passed level 3.
Wow.
So it's just a preparation thing, right?
Yeah.
And it was it's a post-licensing requirement because I wasn't licensed by CRO prior to joining Canaccord Genuity. And It was a licensing requirement, and I'm registered as a associate portfolio manager now. And they needed me to have that done to get me registered as a portfolio manager, and then hopefully another couple months to be a supervising portfolio manager. Because as our platform grows and there's more managed accounts, we need more supervisors just to kind of keep an eye on things.
Mm-hmm. So you named a couple position titles as well as a group with Portfolio Solutions. Can you, broadly speaking, tell us what you do and how, and also coming from different organizations in the past, from Canaccord, any sort of differentiators with Canaccord and what you've seen thus far?
Sure, no problem. So my title at Canaccord Genuity is product specialist. So essentially what that means is I have oversight responsibilities for all of our third-party managers that we work with. And the whole product shelf. So that's anything from GICs, super simple, by the way. So it's, a GIC, in my mind, if you're not IA and you're picking a GIC for a client, you're basically probably choosing what's the best rate at that particular point in time, and away you go. And that goes all the way to structured product, which can be infinitely complex, OM products, hedge funds, private placement products, that sort of thing. I also do mutual funds, ETFs. The only thing that I don't do is pick individual securities for clients. So if an IA wants to sell individual stocks or bonds, I don't really have a view on those. If you ask me if I would buy Scotia over TD, I think my answer would be, I don't know, but it's probably good to have exposure to Canadian banks. So maybe look at an equal weight ETF or something along those lines. Mm-hmm. So that's really what it is. So my job is twofold. One is the oversight on the shelf and the investment research for the managers, ongoing due diligence, kind of making sure that everybody that we're working with does what they say they're doing. Some firms I would categorize as higher risk just because of their asset class or the transparency, size of the team, maybe some operational issues, etc. And then the other part of my job is I work on a broader team called Portfolio Solutions. And what Portfolio Solutions' broad mandate is to work with advisors on modeling their practices. So what that is really just simplify advisor practices, to have model-based solutions so that advisors can free up their time and do what they do best. So, the financial planning, the client servicing, planning, like all that other value add stuff that advisors should be doing when necessarily they're not. Maybe the investment management is extremely important because that's how you achieve goals is by, asset allocation, that sort of thing. But helping an advisor streamline the business and pick the best possible products they can is how you, build your practice and find time to do all the other stuff that you need to be doing.
I found in my own experience over the years, that's what really matters, both in terms of building a strong practice and what ultimately matters for the client. It's more the financial plan and also the regular contact and regular handholding through up and down markets. I always tell all my clients, the only thing I can guarantee them is there will be a market crash. There will be, a 20%, 10% correction at some point in the next couple of years. I cannot guarantee anything else, but what we can do is we can work on a financial plan and make sure you're invested in the right mix based on what your objectives are.
Yep. And I actually worked with an advisor in Calgary not too long ago to kind of help her do her models and get her book kind of up and running.
Mm-hmm.
And I had told her, the product guy wants you to use less product, which is probably kind of an oxymoron, so to speak, because if you look at our product shelf, we're open architecture at Canaccord. So we have relationships with over 150 managers. I don't know the exact amount off the top of my head now. And you can invest in anything and everything from index funds to private infrastructure. So in my mind, it's really about, what are your client goals are, how you actually think about the markets as a portfolio manager, where you think there's certain efficiencies where you can add value, where you can't add value, and, kind of running your book that way. And like you had said, it is the financial planning piece where I think that guys like you can add your value, because your client comes to you, and I'll just use an arbitrary example. Well, let's say they're like a 40-year-old professional, and, they've got kids and mortgages and, car payments and probably a high income, but also debt, student loans, etc. So they're thinking about maybe buying a house or buying a bigger house or sending their kids to university or retiring. Well, retiring, I guess we should all be thinking about retiring, but they're thinking about retiring. And they're coming to you with really about a plan. So I do think that, the financial media talks quite a bit about, indexes, and the S&P 500 is this barometer of how everything performs. And I agree. The S&P 500 is pretty difficult to beat, but I think at the end of the day, you do a proper financial plan and you and your clients have determined, we need, 7.5% to retire with the lifestyle we want, and we need 6.5% to send our kids to university so they're not strapped with debt afterwards. As long as you can get those goals, I don't really think the client particularly cares about what an index is doing. I think they just want you guys to answer the question, and I think that big question is, am I going to be okay?
They should, yeah, they should.
So products are important in that equation, of course, but they're not the only part of that equation.
So as a self-professed product guy, there's 1,000, equities out there publicly traded, and the permutations and combinations make many thousands of different potential funds, and then all the private stuff as well. So just give us a better, and there's a better understanding as to just how many options are out there, how many you go through, what are some key things that you look for when you're looking to kind of help filter and approve these funds?
Yeah, that's a good question. I don't know if you're going to attend the call tomorrow at 11 a.m. of the portfolio that I had just built, but you'll see at the beginning of that, there's 350,000 publicly traded mutual funds and ETFs. And I think that's growing. And then if you were to add privates, that number goes up. And then if you think about, structured products, and then you look at individual securities, et cetera, it's kind of an infinite list, right? So what I think is the best place to start, and this is where I always kind of start because it's kind of hard to figure out, what you would invest in if you don't really know your asset allocation first. So we could talk about location in a bit, but asset allocation I think is extremely important. So I'd say you start with your policy risk. So what's my policy risk? When I say policy risk, I mean strategic asset allocation. And there's multiple ways of doing it. There's ad hoc, there's naive diversification, there's the whole, which I don't necessarily agree with, but it's, you subtract the client's age from 100, and that's your allocation equities, etc. But once you actually figure it out, like, I don't know, I'm going to do a 60-40, so that's your classic balanced. And on my 60-40, it's a taxable account, so I probably need a little bit more allocation to Canadian equities because of the dividends and that sort of thing. Then you're looking at, I don't know, so 60-40, and I've recognized I want 20% of that to be in Canadian equities, and then maybe 30% in global equities, and then, I don't know, 10% in REITs and emerging markets or something along those lines.
Mm-hmm.
So what you would do from there, now that you want Canadian equity, then you need to kind of look and see, well, what is my view on the market in terms of, factors? Do I believe that, Canadian markets are actually inefficient? We'll talk about that too. And if I do believe they're inefficient, then maybe I'm going to look at an active manager. Now I'm kind of concerned about what the manager's style might be. Do I feel like this is a growthy type market? Is it value oriented? and that sort of thing. And then, so what I generally do is I would run like a lot of screens on this and come up with, a short list of managers. And then what I like to do is grill the manager. So I will actually ask the portfolio manager, the person, the guy or girl running the strategy, for a meeting. And in that meeting, we'll talk about, their philosophy, their portfolio construction process, sell discipline, and then you back all that up with quantitative metrics and kind of understanding how you're running, how they're running that strategy, and is that qualitative assessment actually backing up their quantitative metrics. And then you kind of decide how much you want to allocate to the manager. So what I kind of look for too is managers with conflicting styles. So if you have a particularly large allocation, let's say it's 40% global equities, and again, I'm just making a number up, you probably don't want to put that all with one manager. Or if you, as a portfolio manager, you pick your own stocks, you probably want to complement the stocks you pick with a manager that has a conflicting style of how you run money. So what I mean for that is you might pair a growth manager up with a value manager. And then you kind of have different pieces of your portfolio that are kind of firing and working at different times. So it could be, it sounds like it's a daunting task. I certainly don't know every single product out there. I don't know every single product on our shelf when it comes to mutual funds, that sort of thing. I have way more oversight on the OMs and the private offerings, just because they require more oversight.
Mm-hmm.
But for the most part, that's kind of what we're looking at is I think it all starts with that policy risk, that strategic asset allocation.
We all know Morningstar very well. They do their star ratings of funds. I'm going to ask you two questions. One is, how much of a weight do you put on those star ratings? And second, Morningstar also years back came up with their 5 Ps, I think it is, sort of people, parent company, price, philosophy, process. I think those are and performance. Do you put much weight on those, or do you put much weight on either of those things? Do you have a completely ad hoc system of your own when it comes to determining?
That's actually kind of funny. So I don't really pay too much attention to the star rating in Morningstar.
Yeah.
But I did read the methodology, and the methodology is almost identical to the way that I might think about returns. So it's actually, the star rating is how the fund rates against its peer group over 3, 5, and 10 years, essentially. So again, incredibly important. But what you just said about the P's, the people, the process, the organization, that's actually really, so that's really qualitative, and that's hard to, I guess, assess and put a score on. But you want, fund managers that have been on the strategy that are tenured. You want fund managers that invest alongside their unit holders. You want an organization that has a strong culture of compliance. You want them to have the operational aspect, have a good back office, solid trading systems, policy and procedure for trade errors, IT security. So when I'm assessing a manager, especially somebody that we're going to start doing business with as a fund manager, as a wealth manager, I spend probably more time on the operational aspects of their firm versus the investment. So my job is kind of twofold. I do the investment due diligence and the operational due diligence. And I always kind of tell advisors and anybody that'll listen to me that operational due diligence doesn't produce any alpha whatsoever, or operational risk, doesn't produce alpha whatsoever. So
alpha being the return above and beyond what a benchmark or index.
Exactly.
Perform.
Yeah, exactly. So you don't get any outperformance by cutting corners in operations.
Right.
And that's like the more boring part of investing. You talk to a hedge fund manager that might be equity market control, and they'll tell you, I've got 275 positions and this is my clock model and all that kind of stuff. And I'm, well, great. Have you kind of given any thought about your business continuity plan? What happens if, your server goes down? How you guys are going to back that up? And to be truthful, a lot have and some haven't. So what we're looking for too in this is a clear segregation of duties. Like, you obviously don't want a hedge fund with a 2-man shop where one person is the UDP, the CIO, the CEO, the CCO, which exists, by the way. So those types of things, you want to, that would probably kill due diligence from the beginning if you find something.
I remember a few years ago, there was a particular company, we had them on our SMA platform. They were very popular. I won't name anybody, and I very much respect this company too, and the people behind it. one of the reasons we took them off our platform, my understanding at that time, and this was about 2016-ish. I don't know if you were already with us, Andrew.
I was not. I started in 2020, but I know who you're talking about.
You know who we're talking about? Great company, great portfolio. But the reason why we had to take them off the platform, I think, had to do largely because that key risk, that key person risk, right? There was too much of the company was focused on one star manager. And that's something, even as a mutual fund, anyone buying mutual funds, and I've been using mutual funds for many years with my clients. I used to do a lot of that stuff, picking and choosing, using Morningstar Pal Track, picking and choosing the funds in a client's portfolio. And I've been both bitten by the risk of key person. For example, using a particular emerging markets fund that had a very bright lady managing that fund, and that lady then left for another company, and suddenly all the money flowed out of that emerging markets fund. Again, I won't name names, but you know exactly what I'm talking about. I've kind of come to the conclusion that choosing a fund because of a star fund manager, not a good idea. You don't know if that fund manager is going to be there forever.
So that's very clear. So that's something that you got to look at is obviously their business continuity planning, their succession planning. You're right. It's the process, I think, in some of these firms, like a Capital Group out in California, they have such a well-defined process and these strategies that have been running forever, and the portfolio managers come and go. And don't get me wrong, they're absolutely expected to perform when they're in the job, but they have a place that when these portfolio managers come in, even if they're going to be in the role for 15 years, they've already started training their successors.
And that's actually a good example. That's one of the companies I did some in-person due diligence with back in 2014. I actually visited their headquarters in LA, and also where I first heard about that whole 5 Ps, and this is the type of stuff that matters, not just performance. And I don't want to speak too favorably about one particular fund company, but they're one that I use. And the reason I use them is because, there's no star fund manager. They have a sort of a team-based approach. They split the funds between some portfolio managers and some research team. So if one person leaves, it doesn't completely blow up the fund. And long history. Also a commitment to lower costs, right? They don't advertise a ton, and as their funds grew, they reduced their MERs. I'm sure you found the same things about them, right? They're on our platform, anyways.
I'm not recommending any particular products there, but that's just a really good example of a company that's got all those kind of boxes checked, right? And they have a really good, development plan for their people. Operations, like they've got that buttoned down, like they're trading. And I'm not to say that they can't make trade errors or anything along those lines, because everybody does. But they would have a very fast way of correcting that. And then any trade errors that they made that, were detrimental to the clients, those clients would be reimbursed quite quickly.
And I literally stood in their trading room on whatever 60th floor, whatever, Bank of America Tower in LA. So it's neat to visit those companies and see how the sausage is made, I guess, when it comes to mutual fund companies.
So there's some really good companies out there like that, and that's just one example. I mean, we have several on our shelf, and that's what that is really what we spend a lot of time on is figuring out what it is that that they've invested in that. And I always kind of make the argument that if you're gonna you have to invest in your business. And yes, it costs money. But you know what? If we're going to entrust our clients' money with these companies, I want to make sure that they're going to be around tomorrow. And so that would probably be very important, I think, from that whole process kind of organization. So when we I talk to portfolio managers, and I'll score the person, like how long their tenure is and that sort of thing. I'll also score the organization, how much capital it has, and is there any kind of negative kind of regulatory events going on with that company or anything along those lines. And then you want to really look at their process. You want to understand how it is that they choose stocks. And then if they have a really strict style, let's just say that they're value managers, which hasn't necessarily been the greatest style in the past 15 years, probably anyway. It just, but if they're sticking to that style and they are, so kind of how they invest, so you could kind of make ideas about how they're going to perform in certain markets, and narrow, tech-driven earnings kind of don't matter kind of markets, not your value investor markets. But that shift that we've seen recently, where you've seen a lot of money kind of flowing out of tech into small caps, et cetera, those types of things may favor those managers. So we'll see what happens with them in the next couple months.
How long does this whole due diligence process take, generally speaking? And then also, within an organization, there's maybe multiple different types of funds. Have you had cases where the firm as an overall has been, excellent, let's say, but then there's a fund within that umbrella that's like, no, we don't like that, Kim, or that sort of situation, but we'll let the other stuff. Has there been, or is it more of a blanket policy?
It's kind of more of a blanket policy. So I'll kind of explain it to you. So that would be more of a, if we have an organization with some approved funds and we don't want to approve all of them, that would be more on the higher risk products. So if it was private real estate or something along those lines, we may approve a certain fund, but not another one. But typically what we do with firms that run NI 81-102 products, so for your listeners that don't know what NI 81-102 is, it's essentially the national instrument that regulates investment funds sold by prospectus in Canada.
Mutual funds.
So mutual funds, yes.
Open mutual funds.
Open-end mutual funds, ETFs, and liquid alternative funds, both ETFs and mutual funds. So that particular national instrument gives you there's a lot of oversight from the regulator if you're sold by prospectus. So what we do is we will diligence the firm, and if the firm passes the diligence, like the IT security, that sort of thing, then I will automatically open up their mutual funds. There's not a lot of operational risk for Canaccord of having a Canadian large cap value mutual fund approved. Not to say that it's going to perform well, it may or may not, but that's kind of also up to the advisors and being if an advisor's working with me to kind of select managers to kind of figure out if that Canadian large cap value mutual fund should be in the client portfolio or not. So there's definitely a difference between investment risk and operational risk. I always kind of, make the argument that you invest and, what's topical, you get, run an increase in interest rates and the bond market kind of falls apart and the equity market kind of falls apart at the same time. And you're down 25% per year. I would call that investing. You have a manager that you're dealing with, or even if you're indexing or something like those lines, you're down 25%. That's just kind of a reflection of what's going on in the macro environment. What I'd say is inexcusable is if you invest in one of these companies and, the manager is taking client money to buy condos in downtown Toronto for their own personal wealth, which is a true story, or something along those lines, right? So that's why, when I do due diligence, you ask me how long it takes. It takes probably, a month or two. I'll read all the offering documentation and everything, but what I won't do is I won't just onboard somebody without actually understanding the business. So I'll go in there and I will actually go to the business and I'll walk around and I'll be like, hey, introduce me to your trader. Let's chat with the chief compliance officer and talk about policy and procedure. I don't really understand what they're talking about, but I will make time to talk to the IT security person to make sure that they have, malware in place and that sort of stuff. Although those guys speak a different language sometimes. And obviously the investment team, but what you get, and you get a lot of that from offering documents and stuff like that, but what you get from Insight visits, like you just said with your visit to Capital Group, just get a much better understanding of the business and the people behind the business. And then you kind of have an understanding of who you're investing with. And you actually, at the end of the day, you invest with people, right? I'm hiring I'm hiring Justin to do my RRSP. Well, I'm investing with Justin, right? So I've got to put my trust in Justin and he's going to do that. Justin hires an ETF manager as one of his products. He's putting his trust in that manager, right? Whether it's fixed income or whatever, he's hiring them to do their job and to deliver for his clients. So I think that's really what it is about. So that's, and I have done Insight visits and I've come back and, set up meetings with my boss and our chief risk officer and said, hey, we can't do business with these guys. I've removed people from our shelf because they've had, poor structures. And I just don't want our clients to have to bear the brunt of that.
I think earlier you kind of talked about efficient markets, and you mentioned, is this sector, i.e. Canadian equities, an area where it makes sense to use active management? Is that the kind of view you take when it comes to choosing an active manager? Is index the default? And to choose an active manager, there has to be some reason to expect alpha, I guess.
Yeah. So one of the first things I ask when I talk to an active manager, and I know that active managers, there's lots of
closet indexes.
There's some closeted index for sure. But when the first question I ask when I'm asking for somebody's product, or not products, excuse me, process, is the first question I'll ask in a meeting is, what inefficiency does your strategy take advantage of? So another way of, I guess, of defining inefficiency is edge. So what's your edge? Like, what do you do that no other fund manager out there does, and how do you do it better? And that's pretty tough to answer if you're investing in like US large caps, for example, right? So if you have an edge, basically it's something that can't be copied, and that's really the only way that they're going to succeed in the long term. Those edges, you've got your informational edge, right? So some people just kind of understand their stocks better than anybody else. Like we're working with a small cap manager now, and he's on our platform. They will do something like 4,000 in-person management team meetings a year to come up with a 40 stock portfolio, and they're performing really, really well. But I think it's just because they're not comfortable, because they're relatively new. So they haven't, accumulated billions upon billions of dollars, and they're just kind of want to make the assets sticky now. And so they really are out there trying to drive those alpha decisions. Understand that. You have a technological kind of edge, right? So you see some of that in some of the quant models and machine learning and that sort of thing. You have a structural edge. So when I say structural, I mean, the first thing that comes to mind is like Warren Buffett. Like, this guy basically is like, I'm just going to buy a company, and if I don't have to trade it for the next 50 years, I'm fine with that. Which I don't think everybody can be that patient, but I just think that he's your classic buy a company because it's a good business and then kind of forget I own it. And you can kind of see what that's done to his wealth over time. And then I guess the last edge that I'll probably touch on is your behavioral edge. A lot of people are very short-term focused in nature, especially fund managers, very high turnover, that sort of thing. So you find some fund managers, like there's this really good fund manager at a really large shop that is a pure contrarian. And I love his fund. And when I was talking about his process, I'm like, what do you buy? And he's like, I cover a lot of stocks because I want to know what's going on with every stock at every time, at every moment. But also this company would have a lot of analysts and all that kind of stuff. And he says that he wants to buy companies that are in the hole at the point of maximum pain. Right?
It's kind of a Frank Kundal approach, eh?
Yeah, I guess so. So it's and then there's also managers at the same firm that are running, NVIDIA, Facebook heavy growth type portfolios and that sort of thing. But anyway, so with that behavioral edge, he's buying this stock at the point of maximum pain. So this is probably the point where everybody's kind of sold out of it, or everybody's lost their
capitulated. Yes.
Yeah, capitulated, exactly. Then you see, I don't know, maybe they come in and they hire a new management team, or they launch a new product or something like that. And you see kind of a turnaround. And the market can be slow to recognize kind of those turnaround stories, but that's also I guess a good way to look at that, because he's not concerned about, the next 6 months of how this is going to happen. He's more of the 3 to 5. And you see that in his comp structures. Like I think he's most heavily comped on his 5-year number.
The longer term one, yeah.
Yeah. So really, so I mean, if you're going to day trade, he's probably not the guy to day trade with. But if you're going to, looking at a long-term asset allocation, been running the fund, I think, since 2009 or something like that. So we talked about that, tenured, really solid organization, process he hasn't really deviated from, all that kind of stuff. So that's the stuff you'd look for in active management.
A lot of these the funds that you've referenced, the PMs that you've referenced,
Yep.
they've generally been, again, as you mentioned, prospectus offering type of funds. You had also mentioned that you spend a fair amount of time, and probably more time, relatively speaking, in regards to the offering non-prospectus offering,
Yep.
kind of the private goes and the OM type products offering memorandum. And now these days, more and more of those mandates are starting to come out, and you hear about it: private credit, private equity, direct lending, what
We
have
hear
you,
way
right?
too much. They're
a lot,
calling us
right?
all the time advertising their products.
And so I just wanted to ask, I imagine it's a very similar process in with those mandates and those managers, maybe a lot more deeper digging, longer time. But as a whole, I think that part of the reason why these have become so popular, or become, flavor du jour, or the month, or even the year, is that we've heard a lot about. You should invest like a pension plan. Marcus and I have talked about CPP and all the Maple pension plans and what have you, Yale Endowment Fund, and how a lot of them, they invest differently than, Mr. and Mrs. down the street. And that institutional long-term mandate outlook, that the type of portfolios that they hold, is that something that individual investors should actually try to emulate? Are pros and cons in doing so?
So, yeah, no, that's a tough one, because that is like, I'll have a private assets manager. I had a coffee with somebody that was trying to get on our shelf that did private real estate. So private real estate is probably not a bad asset class to invest in if you have a really long-term high time horizon. I mean, you have cash flow, but it also depends on the market. And if I just go back to economics 101, supply and demand, right? Like all that kind of stuff, that's extremely important. But what people don't really appreciate until they need to appreciate it, and then when you need to appreciate it, it's too late. Private real estate is not liquid, right? So if you invest in apartment buildings, that's not liquid. I don't care how it's being sold. A building, if you need to get your money out and you need to sell a building, it is not something that is going to happen quickly if you're going to get the value of that building that you particularly need. So I've had coffee with a private real estate manager that was trying to get on our shelf. They come in and they see us in Toronto. We have a very nice, coffee lounge in Toronto. So next time you guys are in Toronto, come and we'll have coffee. And the first thing he says to me is, the Yale Endowment Fund is approaching, I forget what it was, it's like 40% in private assets, and they've got 15% in private real estate. And that's a good, yardstick for your clients. And I said, yeah, but the Yale Endowment Fund has a perpetual life. The Yale Endowment Fund doesn't have tax issues. The Yale Endowment Fund doesn't have biases. And you guys deal with clients on a daily basis, so you probably see biases all the time that you may have. I get biases all the time from advisors that I'm like, oh God, I never thought about that.
Sure.
Start thinking about the Yale Endowment Fund doesn't, want to look after, their grandchildren. The Yale Endowment Fund doesn't want to pay for the kids' education. The Yale Endowment, you know what I mean? It kind of goes on and on. I think private assets are okay. I don't think, allocating it to the same way that a CPP would is right for the majority of individual investors. Now, you can make the argument that it'd be right for some, probably more higher net worth investors with like very long time frames that don't need cash, etc. But I think, especially in the retail world, liquidity is extremely important. And clients, I do think, will say, I can lock my money up for 10 years, and then, 3 years later, they're like, hey, Mark,
life happens.
I need my money back. And you're like, oh,
yeah,
you can't get it back. It's with the company for the next 7 years. And they say, we never talked about this. Or they did. And if you guys are good advisors, you've had them sign an IPS and they understand that and all that kind of stuff. And there's just so much more to think about, I think, in the retail world than what is Yale doing. And Yale's very good. David Swenson, he's like, I like to read stuff by him. He's very smart. Definitely something to learn from. So I'd say if you're going to allocate to privates, my first comment would be, don't allocate everything to one manager. because you can have a little bit of diversification there. And diversification does not mean that, you hire 4 different mix for your, you might, so if you decide you want private mortgages, you might do 1 MIC, maybe a direct lending fund, and then maybe private equity or something along those lines. So you get a kind of a mix of these types of things. But I think one of the reasons why you've seen, these things become so important or so big in the retail space is, one, a lot of these institutional managers that are coming to Canada, they have great products, by the way, great teams, good all that kind of stuff. They have recognized that the retail market is a good place to raise capital and charge fees. And there's a big competition for them to get client dollars, and products are good, but they're absolutely 100% not right for everybody.
And would you say also they're not really a requirement? I mean, if someone decided that stuff's for the too hard pile, as Warren Buffett would do, I don't need that in my portfolio, I don't want that, they're fine, right? They're not missing out on something major slice of the portfolio that everyone has to have.
No, they're not missing out. There's different ways of doing that too. So we talked about private real estate, right? Like you can invest in a private real estate fund that invests in apartment buildings. Guess what? You have public real estate funds and public real estate securities that invest in apartment buildings. One of Canada's largest apartment realtors or apartment landlords or whatever is publicly traded on the TSX, right? So if you're interested, you think Canadian apartments are a good investment, you could invest with them. And the difference between doing that, via a publicly traded REIT and a privately traded REIT, I guess there's 2. One is you're kind of at the whims of the market, so you do get volatility in those products because it does trade, minute by minute. But you also get liquidity. So you buy the publicly traded REIT, you can buy in the morning if you want and sell in the afternoon. You can't do the same thing with a privately traded REIT.
If I wanted to day trade an apartment building or a shopping mall, I could do it if I wanted to.
That would be tough. Yeah, and there's something to be said about the illiquidity too. If you're not regularly striking NAV, so for your listeners, NAV is net asset value. It's how they value how funds value themselves, and essentially it's what the fund is worth after you subtract the liabilities and divide by the units outstanding. If you're not regularly striking NAV, then you don't see that volatility either. So there's been kind of studies and articles written that, private assets help clients stay invested because you don't see the kind of fluctuation.
Yeah, you see more of a straight line.
Yeah, you see more of a straight line, right or wrong. It does help with your portfolio volatility and that sort of thing. And then also, you talk about different premiums and things like that. So if you look at like, bonds, for example, your lowest paying bond should be your government's, right? Because they should be riskless and that sort of thing. And then you add, credit risk, and you add, the longer you go out, you should be compensated for that. And then the less liquid it is, you should be compensated for that.
Liquidity.
Premium. So you do you should theoretically have an illiquidity premium for some of these privates, which does play out in certain points in time in the market, and sometimes it does not. But it is like you want to be compensated for holding something illiquid. Then you cannot be surprised when you go to pull your money out, which has happened multiple times, and the fund manager says, actually, you can't have it right now.
Yeah. Some public
stories
on that.
Yeah, it's a balancing act for sure.
One last question for me today, then, at least. By extension, a lot of these private investments require you to be of a certain accreditation. There's an accredited investor status that's out there, and the numbers haven't changed. Inflation has changed lots of numbers over the years and decades, but those numbers that are associated and the requirements for an accredited investor have not changed. We won't go into the details what they are today, but my general question is that, in your opinion, Andrew, do you think that those numbers or the criteria require some sort of update, whether it's numerical or more on a philosophical, educational, technical ability awareness?
Probably more on an educational awareness, to be 100% honest. I think it's that accredited investor status. I think if I were to look into it, obviously it's there to kind of protect the client. If you read an OM fund, they all, and not all of them are overly high risky, but they all say, This is a speculative investment. You do not invest.
Warning.
Or lose.
Yeah.
Exactly. And you have to sign off on that, right? So I think it's the accredited investor there is something to kind of protect the client. If my whole investment portfolio is $100,000, I'm not really sure if I should lock 50,000 of that up into private infrastructure that I'm not going to see for the next 10 years. Now if my investment portfolio is 10 million, I could probably lock $500,000 up in a private infrastructure fund for 10 years. And I mean, again, it depends on my objectives, and if my advisor's good, they've done their KYC and they understand all that kind of stuff. So I think that the accredited investor requirements, one is probably the education piece, so advisors understand and clients understand what it is these asset classes are doing and how they might fit into a portfolio and the diversification benefits, etc. I also think that they're, in a sense, there to kind of protect the advisor too. You know what I mean? So you're looking at that and selling to clients. I think it's just kind of a stop and say, hey, who am I actually soliciting this product to? And can they truly handle, the types of risks and things that come in there, come within investing in something like this. So it's, and again, all just like we kind of talked about on the public managers, like mutual funds and things like that, they're definitely not all created equal. Private managers are certainly not all created equal either, in terms of deal flow, the way they may underwrite private debt, what they might be looking at in terms of, where they're looking at investing. And then with the proliferation of private assets, it's also pretty interesting because the amount of private equity that's out there these days compared to what it was 10 years ago is much higher, which means there's much more competition for private equity deals, which means that they're probably paying up for private equity deals, which means they probably generate lower returns going forward.
Mm-hmm.
Remember, I'm using the word probably because there's going to be exceptions to all the time, right? But
there's a lot of money, and I think it's a good point to be aware that people are bidding up things, even at these rates.
Yep. Yeah, definitely something to take into consideration.
All right, shall we wrap it up?
Sounds good. Rock Chalk Jayhawk.
What's that?
They're gonna have a decent football team this year, so that'll be good.
We'll speak about the basketball team another day.
The basketball team is always pretty good.
Not without its controversy in the past recent memory too, though. But
yeah,
suffice to say, yeah. Excellent. Well, thanks, Andrew.
All right, thanks, you guys.
Thanks.
Hey, have a good one. Bye.